for a long time now, for the last couple of months, I've really been trying to think about the upside tail that we could see in our markets. Markets are driven by tail events. Basically, what that means, if you don't know what a tail event is, it's like COVID that kind of comes out of nowhere, and the boom to the consumer and that we seen during that time. That was a tail that nobody could forecast. So what really drives markets more than anything else is unforeseen events. Okay, this is like World War II that obviously nobody was expecting at that time, that really boosted the American consumer after the war, that boosted manufacturing, that caused a boom for the U.S. economy. Since then, really, it hasn't stopped, okay? The markets are driven by tail events, unforeseen things that happen, good and bad. Now, I've been trying to figure out what the tail event could be in 2025 that markets are not expecting that could push markets higher. Trying to kind of formulate this risk to reward profile of, hey, should we be investing here? Is it time to pull back? Are we in for downside surprises? And I came across this video that kind of perfectly sums it up from CNBC. It says, former NEC chief economist says tariff worries are overblown and inflation will drop under Trump. Now, I don't give a rat's ass what political spectrum you put yourself under. Okay, doesn't matter. This is what I've been saying now for really since the election, that I don't think inflation will be as high as the markets think. And I don't think tariffs are going to be as extreme as they were promised under the campaign trail. One, because the markets are going to dictate what Trump can do as far as tariffs. If Trump announces a tariff and the markets crash on that, like, it's not going to be implemented, right? Anything that really threatens financial stability, that does not progress the U.S., ahead, is not going to be enacted. And these are two tail events that could drive exceptional returns next year if inflation falls more than expected, allowing the Fed to cut rates more than expected, and if Wall Street is wrong on tariffs. These are two big upside positive surprises that we could have next year. Now, I think if these two tail events did happen, lower inflation, more cuts from the Fed, and less tariff worries, or the actual tariffs that we see are not as bad as we think, I think this would really drive the small caps, the cyclicals, the mid caps, obviously more than big tech. So we'll talk about that in just a moment. But first, I want to play you this clip. It's 3 minutes, 54 seconds long, and I highly recommend that you watch the whole thing.
The Fed's preferred inflation gauge, the Personal Consumption Expenditures, PCE index, was in line with estimates for October, according to this morning's data. This latest reading comes as some on Wall Street worry President-elect Trump's proposed tariffs will have an inflationary impact on the economy. But our next guest says that won't be the case. Joining us now is Joe Lavonia. Joe is chief economist at SMBC Nikko Securities America and a former chief economist at the National Economic Council under the first Trump administration. Joe, good to see you. So
Thanks, John. Good to see you.
You say these inflation numbers today are fine, but not great, but that President-elect Trump is going to get it down to 1% next year while moving ahead on tariffs and immigration policy. How does he get 1%?
I'm not sure. It's going to fall about 1%. It's around 3%, give or take a little. So it'll go from 3 down to 2%, which is price stability. And that'll happen, John, namely through a couple of things. Number one, certainly lower energy costs, which filters throughout the economy in so many ways. Energy is such an important input into the production of so many items. And of course, anything that needs to be transported obviously is dependent upon combustible engines and energy. So certainly lower energy costs combined with what I think, John, will be a very supply side led animal spirits increase in capital spending. Capital spending inflation tends to be quite low. And when you have capital investment, it adds to the capital stock or the economy's productive output. And that should also keep inflation down.
Thanks for clarifying that. There's a big difference between down
big difference,
one point and getting
I mean, it
down
could be. Look, under Trump 1.0, inflation was, by the Fed's metric, was actually under 2%. It had a one handle on it.
Right.
So we could get back there at some point. So I'm pretty optimistic inflation is going to come down and that it's not going to be the problem that we've had the last 4 years.
Now, why won't immigration action and mass deportations shrink the labor supply such that the cost of labor goes up and actually fuels inflation?
Well, part of the problem, John, is that we're looking at if these are illegal workers coming in. In many cases, they're not even part of the official wage data. They're not part of the household survey that measures unemployment. And in some cases, they're probably not even part of the establishment survey, which, by the way, shows that we actually have fewer jobs than what the government was reported. We had data last week from the BLS that showed that in addition to the roughly 800,000 in downward revisions we're likely to see as of March of 24, we lost an extra 400,000 jobs by June. So we're talking over 1.2 million fewer jobs. So there is tremendous unused labor, you could argue, in the United States economy. And therefore, this notion of deportation somehow leading to what economists would call is a leftward shift in the labor supply curve, I just think is completely inaccurate.
So you don't buy the argument that the jobs that these immigrants are doing are jobs that the people on the books don't want to do?
No, what I'm saying is I don't think in many cases the people that would be deported are functionally a real integral part of the market. In fact, if we look at deportations under President Obama, we had about 3 million deportations over his 8 years. And under Trump's first term, there was less than 1 million, according to the ICE data, ICE, which is part of DHS. So, no, I don't think that we're going to somehow have this shortage of labor supply. By the way, if we look at the labor market, what we're seeing is job growth slow, labor supply, labor force participation still below its pre-pandemic peak, and we're seeing wage pressures moderate. So we're not going to get inflation from less labor. And by the way, inflation is not a labor phenomenon anyway. It's a money and credit phenomenon.
Let me get
too much money chasing too few good.
Now, as I've already kind of shared with you guys over the past couple of days, my 2025 target for Tesla is $945 per share. Because one big reason is clearly these surprises I think are going to happen. I think inflation is going to be, lower than expected next year. I think the Fed is going to be able to cut rates more than expected next year. And current expectations are only 2 to 3 cuts next year. And this disproportionately benefits Tesla more than it does even small caps or your average mid cap or certainly large cap tech. So Tesla's really in that sweet spot that benefits from more cuts and a stronger economy, if that's what we get. Now, that's the big wild card. How is the economy? Now, I'll tell you right now, from a logical perspective, Trump is taking over as markets are at new all-time highs, as overall confidence is pretty high. The last thing he wants to do is to drive us into a recession. And I think that's why he's going to fish quite a bit in regards to tariffs, just to see what the markets will handle. Because he doesn't want to crash the markets. He's really one of the only presidents that judges his career and how successful or not it is based on what the markets do. Okay, so from that standpoint, I'm pretty confident we're going to have a strong market and we're going to have a good economy, because anything that kind of threatens the economy, it's not going to be enacted. And I think that is a big positive for Tesla. Now, as I've said specifically for Tesla before, Trump and Elon being good friends is very positive for Tesla. Okay, longer term. The next 4 years, I would not be surprised if Tesla's honestly a $2,000-$3,000 stock by 2028, 2029. Partly because of the favorable policies, obviously Optimus and Robotaxi and all of that is going to be much bigger, much better than expected. So I think longer term, you have nothing to worry about. Things are going to be really good for Tesla. In the near term, yes, I think, we're going to have these positive tail surprises with lower inflation, more cuts. But in the near term, it's all about the economy. Okay, it's all about the economy. Specifically December 6th. That's the date you really want to be watching for, because December 6th is the next jobs report. And we're going to look at next week and your economic data here in just a moment. Now, obviously, we'll talk about this more in videos over the next week or so. But starting off Monday, you have ISM manufacturing PMIs. Manufacturing's 20% of the economy. This really doesn't matter as far as moving the broader markets, right? Manufacturing's been in a bad place. I think there's room for things to get better there. If that happens or not, who knows? But we get that data out Monday, December 2nd. On Tuesday, we have JOLTS job openings. The higher, the better here, okay? More job openings, stronger the economy is. Less job openings, presumably the weaker the economy is. So that is something we want to watch pretty closely. It's going to move the markets. Now, Wednesday, we will get the ADP employment change. You're expecting 240,000 for your private jobs report, the ADP employment change. That's a big number. High expectations, in other words. Now, on Wednesday, we will get ISM services PMI. This is part of the risk right now if services were to slow down, which is about 80% of the economy. So you do not want to see a miss on services. That would be very bad for markets. Fed Beige Book comes out Wednesday at 2 p.m. The Fed themselves have said, if you want to see how the economy is doing, just read the Fed Beige Book, because that is likely more accurate than the government economic data that we have been getting. And the recent Fed Beige Books have not been good. Now, Thursday, we will get initial jobless claims, continuing jobless claims, exports, imports. This will affect your GDP estimates, which the current GDP estimate from the Atlanta Fed GDP Now tracker is 2.7%. Estimates have actually been rising recently, so that export-import number could be important as far as judging how GDP is doing, because that will move that number. But it's really all about Friday. Non-farm payrolls last month came in at 12,000. Part of this was because of the hurricanes. Part of this was because the Boeing strike. And people are expecting that's what caused the low jobs number last month. So expectations are 194,000 jobs for November, which honestly could be obtainable, especially since we have the seasonal hiring trends that tend to take place in November. Now, it's high expectations. So if we miss those expectations, December's probably going to be a pretty bad month for stocks. Considering valuations are high, markets are pricing in almost a perfect 2025. That's the risk for December. Mark your calendars, December 6th. If it's a bad report, if last month is revised negative, and let's say non-farm payrolls come in at like 50,000 or 100,000, in other words, if it's a big miss, you're probably going to have a bad December. Okay. If it's a good number, you're probably going to have a good December. Now, markets want to go higher. The momentum is higher, so you don't want to bet against that. But that's the big catalyst for the month of December. I don't even really think anything else matters in December. Definitely not like the jobs report. Obviously, you're going to have the Fed on December 18th. You're going to have another CPI report. All of that will be important as well. But the markets really care about that jobs number. Unemployment rate is expected at 4.1% as well, which again, higher is worse, lower is better. And the Michigan Consumer Sentiment Survey, you're expecting things will get a little bit worse on the headline number. You really want to watch current conditions, consumer expectations, and inflation expectations. The headline number doesn't matter too much to me. It's the specific components in this that will be important. So, next week's going to be big for economic data. Now, tomorrow, you don't have anything that'll move the markets as far as economic data is concerned. Literally nothing. You have some data out of Europe and some data out of Canada, but that's it. I think Tesla is just going to be hypersensitive to the data that we get to the markets, right? I think from a technical perspective, Tesla wants to move higher. We've been hitting higher lows for a long time. You're consolidating here. You've still been hitting higher lows, right? Like, things look pretty good from a technical basis. It all just depends how that data comes out, and if markets overall get more bullish. Now, I do expect there to be a correction in Q1 of 2025, just based on the high optimism that we have, worries perhaps about tariffs or maybe about inflation induced from tariffs, and overall probably a slowing down of the labor market and economy after the holiday season. Now, does that turn us into, a recession or not? I don't know, and it's too early to make that call. But from now until year end, Tesla stock's going to do well if that jobs report on next Friday is good. And honestly, again, I think as long as that is good, Tesla could be at new all-time highs by, the time we start January 1st. People are chasing right now. People are bullish right now. People want to be bullish. The momentum is to the upside, and you never want to fade a market that's at all-time highs, right? You want to wait for that kind of confirmation that markets are starting to weaken. And we have not gotten that yet, especially not with Tesla. Now, the area that I would look for as far as the downside would be about 310. If Tesla falls below 310, that would be marking your first lower low. Okay, because the low we set on November 14th, November 15th was about 310. So if you fall below that, that would be a lower low. That would change the trend from to the upside to the downside, at least from a short-term perspective in a more tactical way. So that's what I would be looking for. Now, I think you want to be prepared to take advantage of the correction when it happens. Now, I think there's probably a 70% chance Tesla rallies into year end and probably a 30% chance markets go through a correction. Really comes down to the economic data. We also have the Fed on December 18th. We have another CPI report. Those two things will be important, but they're highly forecastable, right? Usually you don't get surprises there. The jobs report has been surprising markets a little bit more recently, and I think that's really the big catalyst that will decide what happens in December. So do you want to be all in our markets right now? Perhaps, probably not. I think it's time to prepare for the correction that we will ultimately get. But is this going to be a new bear market or something in 2025? I don't think so. There's a risk of that, but I don't think so. I think Tesla's going to have a great year. I think there's a lot to be optimistic about. And I think Tesla would really have to F it up to have a bad year next year. Again, my price target's $945. On the low side, the bear case is $200 to $250. That's if we have a recession, if things just go utterly wrong for Tesla. But I don't see that as being a high odds, right? So maybe $100 of downside could happen for Tesla, but $600 of upside could be on the table next year for Tesla. And I think it's going to be the year of AI appliers. And I don't think anyone else even holds a candle to Tesla in that regard. So very bullish on Tesla. I would love to see the stock come down, but here in December, it just doesn't seem likely at this point. 310 is a level to watch for on the downside. On the upside, you do want to be just watching for new highs. If we do break above our prior high at about $362, we could be set up for a run to the 386 level. That's the previous high here. And then, after that, you really don't have much resistance to new all-time highs. Last time we really ran and closed above the 360 level, 365 level, we ran to all-time highs, and this was back in late 2021, and it was in November and December that Tesla was very bullish during that time. And I think there's a lot of reasons to be bullish, and I think Wall Street is starting to realize the potential that Tesla has. So let me know what you guys think about this down below in the comment section. I do expect tail surprises in 2025 with lower inflation, more cuts from the Fed. Question is, do we have a stronger economy? Does the economy meet expectations, or is it weaker than expected? That, I don't know. So again, let me know what you guys think down below in the comment section. Have a fantastic rest of your day. Happy Thanksgiving, and I will see you in the next one.